The 7-day official holiday period usually runs from late January into February and marks one of the largest human migration patterns in which millions of workers travel home. As a result of this, it creates a seasonal distortion in the metals markets, in which ahead of the event, raw materials are stocked up before factories, including smelters, producers and manufacturers, halt production over an extended 2 to 3 week period. The central crux is the return period after the holiday, where attention is paid to the level of demand for raw materials, which sets the scene ahead of China's significant two sessions meeting in March. Indeed, a weak consumption response has the power to negatively impact industrial metal prices and vice versa. With China the single largest producer and consumer of base metals, and given ongoing challenges to the outlook in the country, attention will be closely paid to domestic stock levels and manufacturing health in the weeks and months ahead. The delayed start to the Chinese New Year in 2026, in addition to high base metal prices, has done little to encourage a bullish domestic fundamental outlook. Indeed, if we look at where we are with domestic stock levels on a seasonal basis, then unanimously across the base metal suite, stock levels are above 5-year averages. Meanwhile, copper, nickel and tin stocks are at their highest level on record for this time of the year. Meanwhile, looking to domestic refined output, while across the group new record highs were recorded, with the exception of tin, on a year-on-year basis, growth levels came in marginally lower than in 2024, excluding zinc. However, this was in large part due to base effects following China's reopening in 2023 following COVID lockdown. Looking to trade health, 2025 reflected large individual market dynamics. In the case of copper, imports of refined copper and products fell into the red for the year because of US policy expectations on tariffs, drawing over 1.1 million tonnes of copper into the US over 2025. Meanwhile, copper ore imports were the beneficiary, with imports 3 times higher than in 2024. Copper scrap imports also gained over 2025, however, at a slower pace than in 2024, likely on the back of higher prices. In the case of nickel, Indonesia's ongoing ban on exports of nickel ore since 2020 will continue to favour Chinese imports of refined nickel. Looking to zinc, the recovery in zinc mining on higher zinc prices over the 2024 to 2025 period has resulted in ore imports soaring this year after posting losses in 2024, a theme we expect to continue in the months ahead. Looking to tin imports, both ore and refined, remain in the red in 2025, with Indonesian exports challenged by policy change, while the return of Myanmar's largest mine, Manmore, has only resulted in limited output at present. The mine restarted after a 20-month ban in August last year. Looking to aluminium, China is forecast to remain a net importer of refined aluminium for the foreseeable future, having started in 2020, with the country expected to reach its capacity production ceiling of 45.5 million tonnes this year. The trade in part is supported by China's exports of alumina to Russia, with refined aluminium exports from Russia into China posting a record high last year. Meanwhile, taking a step back, China's latest hard economic data readings point to growing imbalances in the outlook and increasing risks to growth. So looking at areas of year-on-year underperformances last year, Q4 GDP grew at its slowest pace since the reopening from COVID lockdowns in late 2022. On a nominal term basis, which better reflects changes in wages, profits and government revenue, Q4 GDP fell to 4%, its slowest level of growth excluding 2020 since 1976. Fixed asset investment posted its first annual decline on record. Property investment posted its deepest annual contraction on record. Consumer confidence remains near all-time record lows. CPI ended the year at just 0.8%, well below the 2% target. And the value of imports fell into the red by year-end, highlighting weak domestic demand. Furthermore, the state-produced PMI reading remains in contraction. Now, if we compare to year-on-year outperformances, exports were the largest upward surprise, with the country posting a record surplus of over $1 trillion, despite double-digit declines on the US on the back of tariffs. Also, industrial production held at steady levels over the last 2 years, in part supported by exports of electric vehicles and semiconductors. In addition, retail sales showed recovery. However, growth was driven by service-led demand over goods consumption, and the jobless rate remained unchanged year-on-year, below the 5.5% target. Now, given all of this in our view, despite announced and future expected stimulus in the country over the year, we forecast the economy will face ongoing challenges in reaching its targets, especially given there were no announcements in the outline for the 15th five-year plan that include any bazooka-style stimulus. Indeed, so far, the current level outlined for issuance of special treasury bonds to local governments is on track to be lower than last year, as too is investment on infrastructure. Therefore, we see a signal for a phase of consolidation and stability rather than aggressive expansion, with GDP likely to struggle to maintain its 5% growth level, given its high reliance on exports and counteractive moves to increased advanced manufacturing, while also increasing efforts of anti-involution. This, combined with front-loading last year ahead of the end of the 14th five-year plan, provides only a moderate outlook for base metal dynamics in the year ahead.